recessions before know how to ride out the storm. However, there are new investors who aren't sure how to move forward. And with higher than normal unemployment rates, homeowners are facing a lot of uncertainty. So here's an article that kind of shows how to navigate for a crisis. While the national real estate market faces significant uncertainty right now, it's important to recognize that past crises like the Great Recession of 2008 have taught us valuable lessons on how to operate when the future isn't so clear. For real estate investors, staying out of the market until stability is returned is certainly a valid option, but for those who have weathered the storm of the past and don't wish to close shop, here are a few core principles. So, number one, patience with the recent spike in unemployment, like mentioned before. A lot of people are looking to sell their properties quickly and at a discount to avoid foreclosure, being foreclosed on. Unfortunately, it is common during times like these that people would end up needing to sell their homes. So as the inventory increases due to the fallout of the crisis, investors need to practice patience and be more selective. So especially when you're dealing with something like that, the inventory of those potentially foreclosed properties could increase, but those investors would need to be more cautious. So it's important to wait, analyze the deal and wait for the property to have some good or some good profit margins, because you never know when they could take a potential hit on the resale value, especially with an economy that's fluctuating up and down. So you don't know. Cost analysis. Number two, global crises or not, significant property analysis should be the pillar of every investor's strategy. However, during times of crisis, properties need to be analyzed with elevated costs and risk factors to avoid taking on the deal that broke the camel's back. So just like investors in traditional banks and private money sources alike need to prevent overextension and mitigate excessive risk right now. As lenders like myself are analyzing deals more strictly and lending more conservatively, investors can expect to see some more of the following changes when approaching a lender. Okay, so it's talking about having to work with lenders during this time, and a few different things they're looking for. So during a crisis, you may see higher interest rates, requiring at least 20% down payment, requiring a proven track record and higher credit score from the borrower. The property must be in a proven investment area, so they're not going to want someplace out in the boonies. They're going to want to be in a major metro area with comps and a reasonable amount of activity, a lower days on market, and just proof that your property can be sold. So in addition to changing the front end cost analysis, investors need to be aware of the falling knife. So if we don't know if real estate prices are going to stabilize, whether they are or drop significantly, the safe bet is to purchase when prices have bottomed out. Not during free fall, where a few months into the project, it could have lost significant value. To account for this risk, purchases need to be made at such a discount that the property can withstand at least a 10% drop in repair value should the market drop between purchase and resale. So kind of just repeating it back here, just giving yourself that 10% cushion, again, because you're not sure of what the economy will do in terms of the value is fluctuating from the time you purchase the property to the time you eventually resell it. The higher cost of capital and possible loss in resale value means that some investments that made financial sense in early 2019 or early 2020 may no longer have a desirable profit margin at this point. Yep, which kind of goes back to number two, which is the cost analysis. So liquidity could be the key. In a worst case scenario, buyer demand could disappear entirely after the property was purchased, which is why investors should analyze deals as both a fix and flip as well as a rental property. So to maintain the option to rent, investors will likely need to choose projects within the middle of the market after repairs. This comes with another added benefit: buyers of federally backed loans. You could also do that, FHA. And insulation. So in every recession, some areas are hit harder than other areas, especially during the Great Recession that we saw 10 years ago. And it's just insulating factors. When it says insulating, it's basically just saying insulating you, protecting you from harsher economic conditions. So when you're analyzing a new market or a market that you're more familiar with, looking out for government, military jobs, larger institutions, larger companies, Austin, Dallas, Houston, or Dallas, Fort Worth, Houston, San Antonio. A lot of those major metro areas, those larger institutions, those companies will bring people, generally have a lot of economic health because of those companies, because of the jobs they bring, so they can withstand the economic fluctuations in the market. And new growth projects and major development projects. So infrastructure, new accommodations for people, different places, retail shopping strips, restaurants, places for families to go, people to go out on the weekends after work, whatever it may be. So there's a wide range of factors that real estate investors have to consider, but namely, buyer demand could disappear when the property was purchased. So for this reason, investors often analyze new deals as both fix and flips as rental properties, just to hammer that home a bit. So in the end, patience, cost analysis, and liquidity are excellent strategies to implement during this time. And that's about it. So take care.